Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we dive in, as always, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's guest is the chief strategist at Mill Street Research, which provides research reports and data for institutional investors covering asset allocation, country allocation, sector and industry selection, and more. It's Mr. Sam Burns. Welcome to the show.
Thank you. Appreciate you having me on.
Yeah, thank you for coming on. I wanted to talk to you because I feel like this show is sometimes an echo chamber for commodities. We hear a lot about a commodities supercycle. We have guests on very often who are bullish across the entire spectrum of the commodity space. I know you have a different view to that, so it's always great to hear a contrary opinion. But before we do dive into that subject, you're a first-time guest, so we have to start with the origin story. So how did you first discover investing, and how did that lead you to becoming the chief strategist at Mill Street Research?
Sure. Yeah. No, I guess some background is always good. So I've always been interested in markets and economics, even from high school and college, and I thought of it as both a you could apply the skills that I had in math, but also learn more about kind of the psychological element of it, sort of the investor behavior and that side of things. That there was, I often think that rather than majoring in economics and finance, I should have taken more psychology classes to be a better investor. But over the years, I've certainly learned a lot about how that works, and I've pursued the traditional finance background, but found that really what I was attached most to was kind of having a structured approach, and in my case, a quantitative approach, having indicators and models and things that are objective to kind of guide and drive my views. Because what I really saw in a lot of cases was people giving investment advice that are essentially reading something in the newspaper that day and taking a view from that, and then trying to make an investment thesis out of it. And then a week or two later, they read something else, and then the investment thesis changes completely. And that kind of doesn't work well in a lot of different areas of investment. And so one of my first jobs coming out of business school was at a place called Ned Davis Research down in Florida, which was very focused on objective indicators and models. They had a million of them. I helped build some of them. And from there, I kind of developed the idea of whatever your investment approach is, you need to have a structured process of some kind. It doesn't need to be quantitative. It just needs to be something where you have a consistent way of analyzing things and don't get dragged all over the place by what's in the headlines. And so I've tried to build a research platform, both at the firms that I worked at before, and then here at Mill Street that I started about 7 years ago now, to be able to do the work that I wanted to do in my own way without having any committees involved, without having investment bankers or trading departments or anybody else to kind of get in the way. Take the best of all the things that I'd built and done over the years, the last 25 or so years, and put them all together in the way that I wanted to do it. So a lot of it has been equity focused. That's kind of my primary focus, but really looking at things on a global asset allocation basis. I have a lot of clients in Europe and around the world that look at things differently than we do in the U.S. sometimes. That's been very valuable. I've worked with a lot of quants, but I've also worked with a lot of fundamental type investors and tried to see what the best way to blend those two things are, and really found that it is a mix, that you want to do both. So a lot of it is quantitative, a lot of it is indicator based, but I do have qualitative opinions on things. Some things can't be modeled, and you just have to kind of go with understanding of the structural drivers of things. And so that's kind of how I got to where I am. So if you look at Mill Street Research's work, a lot of it will have charts and indicators that I rely heavily on, but there'll also be kind of commentary about what's going on and things that that have to be analyzed on a more qualitative basis. So that's kind of the background. I have a BA in economics, an MBA in finance, and a CFA. So all those kind of traditional finance backgrounds, and a lot of quantitative stuff that I built up along the way.
Great. Well, I'd like to draw on your experience and perspective to first hear your opinion on the broad market and the state of the economy. We're always hearing the soft landing versus hard landing narrative these days. Will there be a recession? Will it be a mild recession? Will it be a deflationary depression? I've heard all sorts of opinions, everything in between. The majority of the guests I've had on this show believe 100% we're headed for a recession, a significant correction in the broad market, particularly in the tech sector. I know you're overweight tech and consumer discretionary. So do you see things differently? Is a soft landing possible? could we be in a bull market in the broad markets?
Yeah, I would say I'm most likely more positive on the economy and the market than maybe the majority of your guests that you described. I think we're probably already, in a sort of a soft landing scenario already. Certainly, when I was doing talking to clients and doing media, say at the beginning of this year, November, December, January, February, I heard a lot of the same things. The very strong arguments about there's going to be a recession in 2023. The Fed is tightening aggressively. That causes a recession every time. The yield curve is inverted. Things are slowing down. Fiscal policy slowing down. All these arguments for why we're going to be in a recession. We should have been in a recession right now by a lot of these views, and certainly earnings should have been falling already by a lot of these views. But I think what's turned out to be the case is that hasn't happened. The economy is not in recession, and to my view, it doesn't look like it's going to be, certainly at least through the end of this year. I mean, eventually, of course, we'll have a recession someday, but I don't think it will be near term. And I think that we probably are in at least an upswing in the market that could be considered a bull market. I think we made a pretty good low last October, November, and we've made pretty good gains since then. But I think the main thing that's I think thrown a lot of these analyses off is the fact that this cycle, post COVID, has been so different than all the previous cycles that it's hard to analyze this cycle in the context that you would most of the cycles, at least since the 60s or 70s. And I think that's what's thrown a lot of people off. I think the real difference has been the overweighting of the Fed and monetary policy and underweighting of fiscal policy and other kind of macro policies. And that's really been the difference this cycle, that fiscal policy is a lot more supportive and stimulative now than it was in any of the past cycles, probably 30 or 40 years, when monetary policy has been tightening. Normally you see monetary policy tightening and fiscal policy tightening, and that's what causes a recession. Right now you've got monetary policy tightening, but fiscal policy is still pretty stimulative, and they're offsetting each other and allowing you to have this kind of soft landing where you have 1 to 1.5% real growth kind of numbers in the U.S., but and solid job market, but not and have inflation come down at the same time, and that's really what you would hope for, and that's kind of what's been happening. So I think that's been the distinction in this cycle that's different, and the fact that everybody was expecting a recession last year or early this year, from an investor standpoint, psychology standpoint, means that that's priced in, and then any good news, anything that's better than expected, produces a market upswing, and that's what we've had. We saw the same thing in Europe. It wasn't just the U.S. Everyone thought Europe was going to be in a severe recession, that the lights were going to go off because the Russian oil supply and gas supply is being cut off, and they scrambled, they spent a lot of money, they did things, and it didn't happen. They managed to get through the winter. Things are they're not great, but they're not as bad as expected, and that's what matters for markets. Is if it's not as bad as expected, markets tend to go up from those kind of low, pessimistic extremes, which is what we had late last year. So we're still, I think, working those off. We've made a lot of movement. People are not nearly as bearish now, maybe as they were, but I think there's still a lot of people, like you said, that are expecting an imminent, downturn. And to the extent that we don't get it, that earnings hold up, then I think we'll get through it, and stocks can hold up for a while longer.
And what are your thoughts on the theory that one of the reasons why we're seeing growth in the stock market still and that a recession hasn't happened is because of COVID stimulus money, both given to individuals and businesses, and that's an excess amount of capital that's in the system. And once that liquidity drains, once that's out of the system, then we're going to eventually see a collapse of the markets.
Well, no, I definitely think that the COVID stimulus that happened in 2020 and 2021 had a big impact at the time, and of course a long tail to it, in the sense that some of that, even though those programs stopped 2 years ago for the most part, the kind of lagged effect of them is still there, even trickling down into like state and local government spending and a lot of those kind of things that are still going on. Now, I think the important thing though to remember is that while the COVID stimulus programs went away, and actually the deficit started to narrow and fiscal policy started to get a little tighter, then you had the kind of second wave, which was the CHIPS Act, the Infrastructure Act, the Inflation Reduction Act, all those things that came along after the COVID stimulus really kind of came along. And those are much less directed at consumers and are much more oriented toward infrastructure and corporations and technology and all that kind of thing that have a less immediate impact, but are longer, potentially lasting. And I think that's kind of what's given us this second leg and kind of the support for the economy, is that the people are building factories. They're building, electric cars and batteries and infrastructure and all kinds of things now, with the support of that federal money, but also bringing in private money. Private companies are investing more because of that, and because of incentives and things like that. I think that's what's giving us this kind of second wave of support. And the fact that the federal deficit is still relatively wide relative to GDP means that there's still a lot of sort of stimulus coming from the federal government, from the Treasury, that is again offsetting what the Fed has done in terms of restricting credit, and the banks have tightened up on credit. So those two things are now offsetting each other, more than having both tighten at the same time. I think that's what's going to kind of carry the economy for another maybe 6 months, 12 months, maybe even a little longer, to avoid recession and to keep corporate earnings relatively higher than they would have been otherwise. And then the other thing is just that there probably won't be a lot of new stimulus packages coming down the line, just because of the way Congress is now split. So those things will eventually tail off over the course of the next couple of years. And maybe that's when you have to really worry more about recession, if monetary policy is still on the tight side and the rest of the world is still kind of slow, because I think those are the things that will slow things down. So I think that there's a lot more of that kind of fiscal support going on than people have kind of really realized, and that's what's keeping us out of recession now, and may continue for another year or so.
So I want to read a quote from your July 2023 U.S. sector strategy report, where you stated, renewed weakness in the commodity sector revisions and underlying commodity prices prompts us to cut exposure to energy and materials further. So as I mentioned at the top of the show, most guests on this program are very bullish on commodities, believe that there's a commodities supercycle that started. So I'm glad to get a view counter to that. So first of all, what are you seeing in the commodities sector at the moment? And is this weakness that you're seeing more of a short-term thing? Do you see this continuing over the long term when we look even 5 years, maybe even a decade out, for the commodity sector?
That's right. Well, I think, big picture, just looking at the major commodity indices, most of them peaked, very dramatically in about June or July of last year, kind of a few months after their, Russia invasion drove, oil and food prices up, starting in February. It was coming off kind of the squeeze that had happened after COVID, when supplies were limited. And we've seen a fairly steady downtrend over the last, year or more now. We've seen a bounce in oil lately, and a little bit in natural gas. Some other things have moved around, but I think the general trend since the middle of last year has been generally down and maybe flat the last few months. So I don't see from the big picture commodities indices the indications of the price behavior of a super cycle. I see what would look like basically a big supply shock, combined with a demand shock that came out of COVID and then was made worse by the Russian invasion. And that's now come off, meaning that a lot of new supplies have come on, both from the U.S., and elsewhere in the world in terms of oil and gas. I think some of the food supplies have been kind of restructured and routed so that they can work around the limitations of Ukraine. And so I think that the supply chains have healed enough that those kind of drivers, the supply drivers, have come off of the commodities in general. So there's always exceptions here and there, but that's kind of what's driven me to be kind of underweight and kind of look a little more cautiously about commodity stocks and the commodities in general, is because I think those supply shocks that drove things have mostly passed. And I don't really see the demand side of commodities coming in a big way, partly because most of the world is not growing particularly fast. Europe is not, most of the developed world is sort of doing okay, but not great. And certainly China is quite weak, I think, weaker maybe than they report. And that's been, I think, for much of the last 20 years, even a lot of the global demand that's been driving commodity prices has been China and the areas around China, and the fact that China was then financing things in Africa and elsewhere in Asia, all kind of the Road and Belt Initiative kind of thing, all those things that China was doing to kind of stimulate demand in China and globally have really faded. They've kind of stepped back a lot, and their economy really can't support the level of global commodity demand and stimulus in general that they had for much of the early 2000s, for instance, or even in 2015, 16, when they put in a big kind of stimulus side, demand for commodities. So I think a lot of those drivers of what had driven things in the past really aren't there anymore, and probably aren't going to repeat, given what we're seeing in China And so I think it's really, there's not much else left to drive big demand side, shocks to the upside. And so it's only going to be if there are big supply shocks that will come to kind of drive, shorter term demand things. So, as an example, oil demand, there's plenty of oil around, and certainly OPEC and Saudi Arabia could produce a lot more if they wanted to. And they've just decided to cut supply, unilaterally as a cartel. But there isn't a shortage of oil or natural gas now. And certainly the growth of LNG globally has reduced a lot of those supply constraints in Europe and elsewhere. So we can ship a lot of the gas that we now have in the U.S. And we've had so much that we waste it, we burn it off, and so it can be sent elsewhere at a profit now. And so I think that's helped balance the global market for energy better than it was in the past. So a lot of these things that are structural shifts, both away from fossil fuels in general and in favor of more efficient production of some of them, like natural gas, kind of keeps the supply side more balanced, I guess, than it has been in the past. So I don't see where the big demand driver is going to come from if China's not going to be it, and it's not going to be kind of the developed Western world. And I don't see where, if demand for fossil fuel is kind of gradually going down because we're shifting to electric cars and all that kind of thing, then I don't see the structural demand there. So it's more, short-term supply shifts. And then, for instance, things like if a refinery blows up on the Gulf Coast, that limits, things and kind of produces spikes in the crack spreads and all that kind of thing in the shorter term. So there's certainly trading opportunities there, but and shows you that things like refinery capacity are very constrained and an issue. They're not going to build any new refineries, I don't think, for a while. So I think those are all the things that drive commodities that they're limiting the upside and make it more of a tactical view than a long-term structural view.
Well, what if we take the theory that the whole energy transition is not going to go the way that a lot of people think it is? We've already seen some issues, particularly with wind energy, and solar can be challenging as well. And a lot of these governments and the political elite at the top, to say, who are handing down these mandates for renewable energy, a lot of them don't really understand the amount of minerals that it actually takes to make this happen. Copper being one in particular that is in very large deficit, at least according to S&P Global and a lot of other people in the sector who are saying that the amount of copper needed to meet the demands of the energy transition is absolutely massive and nowhere near being met. So maybe I'll get your thoughts on copper first in that situation. Could copper be a place in the commodities spectrum where you might look for opportunity, seeing as how sorely it's needed for the energy transition? And then secondly, if the energy transition does not get executed the way that a lot of people think it does, do you think it's possible we may need to be reliant on fossil fuels for longer out into the future?
Oh, yeah, you're right. There certainly are risks to sort of the policy implementation of shifting away from fossil fuels and to other sources of energy. And certainly governments, plenty of reason to think that they're not going to get any of this right, or at least, as right as they would like to. I think most of them see the need for it, but, arguing over how to do it and when and who's going to pay for it are big debates. And so I think, there's been some progress, here in the U.S., but it's still very fitful and could be, reversed or blocked, as we go forward politically. Europe's been pushing that way a lot. China is doing a lot in the terms of electric cars and batteries and things and solar panels. But the question is, can they do it profitably? And does it rely on a lot of, underlying, basically, stimulus support and subsidies, which is kind of the other question, is how long will they be willing to subsidize things? So I think there's definitely risks to that. I think the technology itself is probably always, advancing and will find ways to produce energy with either different materials or at lower cost over the longer term, which is what they've generally done. Certainly the amount of energy needed to produce a unit of GDP has been going down for decades, and that I think will continue. But how we get there is certainly at risk. So something like copper, could see demand from some of these need for building wind turbines or for other things. Now I think there'll be somewhat of an offset in the sense that a lot of the copper being used to build apartments and houses in China or even in the U.S. will be lower than it was in the past. So there may be some offsets in the sense that the demographics have shifted, certainly in China and most of the Western world, There's just going to be fewer people, lower birth rates and things that will reduce demand for some of the older traditional uses of things like copper, and they'll have to be replaced by the demand from new sources like the energy transition and things like that. And then there's a question of how much, if one thing gets expensive, if lithium or copper or something gets expensive, they'll try to find something else that's cheaper or that's more available. And that's, I think, been the sort of the slow rotation, is to see how the technology evolves, whether it can move faster than the supply of, say, copper or other elements that are in demand right now for a lot of these things, for solar, wind, things like that. But the fact that a lot of these, things, copper prices have bounced around a little bit, but they're still down from where they were a year ago, tells you that there's still enough copper floating around. And if places like China are not using as much domestically to build roads and bridges and houses and things, then there's still at least some left over for to be used elsewhere. So I think, I'm going to kind of watch more the price behavior, because it's very hard to pin down, global supply and demand for copper or gold or anything else. A lot of it is hard to track. So I think, if I start to see, demand building up in the price, and then, I also look at the stock prices and the earnings estimates for copper miners or any miners, gold or oil or anything that is produced just tied directly to a commodity. Those companies are in there all day, every day, looking at the long range forecast, deciding whether to build new capacity. The analysts that track them are looking at that, trying to look out 3 to 5 years. Should we build a new mine? Should we build a new factory? All those kind of long-term plans get built into those earnings estimates, and you can use them as an additional way to track them. And so far, most of the trends in those estimates have been relatively kind of flat to down, except for areas maybe like refiners and oil, where there's a shortage that can be used to get excess returns for a while. So I think that's kind of where you have to look, is for specific areas where there's going to either be a shortage or where companies are going to be investing, and rather than kind of a big picture, broad based thing that relies on global demand or global supply estimates being correct.
Okay, well, let's pivot to there. Where are the areas within the commodities spectrum that you are seeing potential opportunity in?
Yeah, so one of them would be things like refiners and some of the equipment makers in the energy sector, where there is a limitation on what they can produce. Oil refineries, certainly in the U.S., take a very long time to build and get permitted for, and you have to really plan out 20 or 30 years if you're going to build one, and haven't been any new ones built in a while. So there is a sort of a fixed amount of capacity for something like oil refinery. Oil production, drilling new oil wells or getting more out of existing wells, has a lot more flexibility to it, and can be turned on and turned off more easily. And certainly it has been, certainly since COVID, there's been a significant increase in production in the U.S. Side of oil production, and certainly in the Middle East, they can turn off the taps more or less when they want to. But refining capacity, and then things like liquefied natural gas capacity, those are things that take a while to build, and they have to make long-term plans for. And so the fact that if you're going to switch from, say, oil to natural gas is certainly a stepping stone toward cleaner energy. I think there's opportunities there in the liquefied natural gas area, both in terms of producing it and shipping it around, and terminals and pipelines, and those kind of things are where you do see pockets of strength in the energy sector. And so I would look for more of those, rather than kind of the baseline production of it. Look for the people who do something with it, refine it or pipe it, or make sure it gets to where it needs to go around the world. I think those are probably where there are more opportunities. And then areas that are maybe less dependent on China specifically. So certainly Europe is going to have a lot of demand for that kind of thing for a while, even though they're trying very aggressively to move off of fossil fuels. That's going to take a while. And with Russia kind of, much less of a factor in Europe now in terms of energy, and in terms of being able to do a lot of things in the energy sector, then I think there are opportunities for people, companies who can take their place in producing equipment, or just providing the natural gas, or even on the solar and wind side of things to produce the equipment needed for that. So I think there's still opportunities there. The question is, when for a while, all the solar and wind stocks went through the roof and got very popular, and then now they kind of come back some. So I think you have to really kind of play the hype cycle a little bit in some of those and make sure you're not buying in after a big run. But there are going to be longer term opportunities there as long as you don't, buy at the highs. You should have opportunities there. So I look at the earnings estimate trends, the price trends, and kind of sentiment to kind of gauge when things have gone too far one way or the other.
Do you view gold in a different category from industrial commodities? And what's your outlook for gold? Because on the gold bull side, one of the main factors that they're pointing to is record gold accumulation by central banks all over the world. They're saying that there's a reason they're accumulating gold, perhaps for a reset in the monetary system. I think a lot of gold bugs were disappointed by the recent BRICS meeting because a lot of people were expecting they were going to announce they're officially launching a gold backed currency. Maybe they'll do that someday, but it would take years to implement and actually launch. So what's your view on gold moving forward and where it stands today? Do you see any opportunity there, or do you think gold bugs are making too much of the central bank gold buying?
Yeah, I mean, central bank, gold activity is certainly a very tricky thing to kind of analyze because, of course, central banks rarely tell you why they're doing things like that or if they're offsetting factors in their overall holdings. I think, the things that I look at in terms from a macro standpoint to drive gold, I do think of gold sort of separately from other things that are, more sort of call them useful, meaning that they're used in some sort of industrial need or consumption. Most gold demand is not for sort of consumption use, except for jewelry maybe. It's more for sort of investment demand. But I think a lot of it is more driven in the sort of intermediate term by real rates and the U.S. dollar are certainly the swing factors in kind of the 6 to 12 to 24 month kind of period time frames. And so I think to the extent that real rates right now have been going up and are fairly high, certainly in the U.S. And have the potential to come back down maybe next year, that would be then a tailwind for gold. The dollar has been kind of range bound this year. It weakened some last year, and now looks like it's been gaining a little bit in the last month or so, and gold has come back in. So I think to the extent that if real rates come down, if U.S. policy rates come down next year, and the dollar weakens a bit, then that would be a tailwind for gold. So those are kind of the cyclical reasons that I would look to be in gold or out of gold, rather than trying to predict a central bank move. I think the concept of the kind of gold backed currency and getting moving away from the dollar in a big global sense, I really don't see that happening. I don't see any other currency or currency block being a real competitor to the dollar anytime soon. Nothing is big or liquid enough or has the capacity to act as a global reserve currency right now. The BRICS as a group just they don't have it. They can't organize that sort of thing. They can't manage it. And any kind of multi-country currency block. I mean, the euro is shown. I mean, Western Europe is a much more coherent group than the BRICS would be, and certainly the R in BRICS is pretty much gone. And so I don't think there's any way for that to be a realistic alternative to the dollar or even to the euro, frankly, in terms of a global currency. And anything gold backed, I don't really see working. We tried the gold standard for a long time, up until the early 70s, and it didn't work well. There was a lot of problems with that. You really can't have your money supply tied to something arbitrary and physical like gold or anything else to make the global economic system work right. So I think it's fun to talk about, but I don't think that that's really going to be a driver for either gold or anything else. Certainly not cryptocurrency or anything else as well. I think the dollar is the only thing right now that can be a reserve currency and be used globally the way it is. The U.S. economy is the only economy that can export enough dollars to make that happen, and has stable enough, financial system to do it. Europe can't really manage it. China certainly can't. So I don't think the BRICS can do it. So I'm not really seeing the currency kind of driver of it. I think it's more of a cyclical move in real rates and the dollar driving demand for gold over and above, just sort of panic. People get nervous, they buy gold sometimes, but that's not a structural reason. That's more of a short-term thing.
So you've mentioned the Chinese economy a few times during this interview, obviously a significant driver for commodities demand. There was the story out there that, well, China was on lockdown, that once they reopened, this was going to cause an explosion in commodities prices and a whole bunch of demand to come online. That hasn't quite materialized how people hoped it would. What is your current view on the Chinese economy and its connection to the commodities market?
Yeah, no, you're right. There was a lot of hype about that coming out of COVID there. Once they dropped the lockdown, that there would be a big boom. And yeah, it didn't happen. I think, China, of course, has struggled with COVID, the whole time. A lot of their responses, you could argue were not great. And I think part of it is there's the COVID part, which of course was bad, but was much more of a shock. But the longer term structural issues in China predate COVID and are certainly going on still now, even as COVID has kind of waned as a factor. And I think it's the fact that over the last, say 20, 25 years, they oriented their whole economy toward supply side infrastructure, top down driven, keeping GDP up by building roads and bridges and apartments rather than consumer led demand. And I think they've kind of run out of runway on that. That a lot of their state and local governments, regional governments have kind of run out of fiscal capacity. The consumer demand is weak relative to kind of that side of things, and their ability to export their way out of things has been reduced. So I think that structurally, China's economy needs to be rebalanced, and that's going to take a very long time if they can do it at all. And the fact that their demographics have now really turned the corner, their working age population is now shrinking, and that's going to limit internal growth and demand in China. So I think they've built up a lot of the things that they 30 years ago they needed a lot of roads and bridges and apartments and things, and now they've built a lot and probably overbuilt, and they have a lot of debt related to it. And it's sort of been infrastructure that's been sort of poorly built in some sense, and since they've overdone it. And now they're going to have to work that off. So it's a little bit like Japan was in the late 80s. They've got to reorient their economy toward a slower growth and less reliant on exports and more reliant on domestic demand. And I think that's going to take a long time and be very difficult politically. So I don't think China is going to be a source of global demand for commodities. And I think their economy is going to be just slower in general. So when I look at, say, the earnings estimates and the earnings trends for Chinese companies in aggregate, they've been weaker than average for quite a while. They still are. And so that tells me that whatever is going on in the reported GDP numbers, it's not coming down to corporate earnings in aggregate for the average Chinese company. There's a few big tech companies that are doing well, but most of them are not doing well. And that tells me that under the surface, the economy just isn't that strong. It hasn't been for a while. And I really don't see a lot of signs of a major turn there. So that would be the thing I would look for, is to say, if analysts start raising estimates for Chinese companies, aggressively, that would say, okay, things have shifted from kind of a bottom up, more granular side of things. But I don't see that. And so I've been underweight China in particular and emerging markets in general for probably 2 years now. And that's generally been the right side of things to be on. Emerging markets have lagged developed markets in general, and China's lagged in particular in terms of the equity markets because it just doesn't have the underlying growth drivers that a lot of people have attributed to it. And certainly have been the GDP numbers that you see published, 5 or 6% or whatever they are, I think are misleading and don't really reflect the actual growth that's going on in terms of that we would consider real growth. So I think there's been a lot of, China, of course, intentionally, a lot of the data coming out of China is difficult to read and is misleading. But even beyond that, they're just in a slower growth environment now, and I don't think that's going to change soon. So I don't see relying on China as a driver for commodities or for the general economy is going to be the driver it once was.
Well, Sam, thank you so much for joining us today. A ton of knowledge shared. Really appreciate it. Before I do let you go, for those who want to learn more, could you tell us about Mill Street Research and anywhere you want to direct people online?
Sure. Yeah. So millstreetresearch.com is the website. You can see a description of the work and a lot of sample reports that I do. There's a blog there as well that I update periodically that has some descriptions of kind of how I look at things. And then I do post fairly often on Twitter and on LinkedIn as kind of the easy ways to just kind of keep an eye on what I'm saying and doing and get examples of what the work looks like. And certainly, if there's anyone out there who's interested, there's a weekly report that I put out for $50 a month for kind of the more retail investor who's interested in tracking this sort of thing, called the Weekly Roundup. And then if there's people who run investment advisors or something that are interested in the institutional side of the work, certainly reach out through the website and be happy to talk to you.
Great. Well, I'll put a link to the website and social media profiles in the description below for people who want to check that out. Thank you once again, Sam. It's been a great conversation, and I hope to catch up and continue the conversation in the future.
Oh, my pleasure. Thanks for having me on.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.